Well, thanks, guys, for coming and giving me your lunch hour. I know the pizza was probably the draw more than I was. That's cool. So I'm Lisa. I graduated from the JD MBA program last May. And for the past year and change, I've been working at August Capital, which is a Sand Hill Road venture capital firm focusing on Series A investments in technology. And Greg told me, it'll really be a hit if you come and talk about blockchain and crypto. And so I've done my best to put together how we think about it from an investment perspective, and I hope that's useful to you. Again, feel free to interrupt with questions. A lot more fun that way. A little bit about me. I went to Thomas Jefferson High School. Maybe there are some TJ grads in the audience. Then worked at Bain in New York for 3 years. Did a brief stint at the White House working at the National Economic Council. And that was the inspiration to come back to grad school and do a JD MBA. It was here that I first met David Hornick, who's featured in the photo gallery over there. He was here last year giving a talk with me and is a partner at August and a graduate of the law school. And that's how I got connected to venture capital and thought that that would be a really fun thing to do. It turns out it's a dream job because you get to talk to super smart people all day and don't really have to make any PowerPoints or Excels, except for this PowerPoint, but that's cool. So that's a little bit about my journey. Earlier this year, one of the things that VCs do is we blog a lot. Earlier this year, I decided I would join the VC bandwagon and publish what I was looking forward to investing in 2018. And so it got published in TechCrunch, which is pretty cool. And these are the things that I was excited about. And one of them, relevant to this presentation, I said, I'm searching for blockchain's killer distributed application. Of course, the irony of that is it's 2018, but the concepts around blockchain have been around since ancient times. This is something called a rhinestone. Turns out there's a Micronesian prehistoric culture, Micronesian island of Yap, and this was their currency. They are limestone blocks. They're about 4 meters in diameter, probably weigh on the order of tons. And obviously you can't physically transact a 4-ton limestone block. And so what the islanders did was they decentralized knowledge about the ownership of the currency. It became an oral history that was decentralized. And when a rhinestone transferred from one person to another, everyone in the island simply moved their oral understanding of who owned the stone. I think that's a very beautiful analogy for exactly what blockchain enables today. It's a distributed understanding of who owns what, who has transacted with whom, et cetera. So Google rhinestones, they're super cool. How do I think about investing in blockchain? There was a blog written by the team at Union Square Ventures a couple years ago, which is where these charts came from, that I think explains this really well. When you think about the web and think about the difference between protocols and applications, applications have taken the lion's share of the value. The protocol layer, HTTP, TCP, it's a utility that's shared by all of the major applications. Why have the applications taken the lion's share of the value? Well, it's no surprise because there's siloed data. What's proprietary to Google and Facebook and Twitter and Amazon is the vast amount of data that they've aggregated about each of us and our browsing behavior and our friends and our networks, et cetera. And that's where the lion's share of the value has accrued. When you think about blockchain, it's very different. In blockchain, there's a lot of reasons to believe that the protocol layer is actually where the value will accrue and the application layer less so. And that's because blockchain, by definition, is a shared data landscape. The protocols enable any application on top of them to access all of the data that exists within the protocol. And so there's not that same proprietary siloed data within a distributed application. Moreover, with a protocol, there's economics of the tokens that incentivize both development and adoption of the protocol more quickly than we saw with the web. And why is that? Well, network effects, traditional network effects, say Facebook's getting started. The overall utility of Facebook when it was 10 people first using it at Harvard, pretty low. And the incremental value of one new person joining the network helped to make it more valuable until it reached a critical density. And then at that point, you get good viral effects and network effects that take over. And that period of time from n equals 0 until n equals density is called the bootstrapping problem in network effects. With tokens, because the first users of the blockchain blockchain utility are compensated with tokens, and they get more token value for being early adopters than people who join later, you actually have this financial utility curve that's inverse to the application utility curve. And so there's reasons to believe, as you all know, that token network effects will actually be a lot stronger than the network effects we saw for the traditional web. So that shows that the protocol layer is actually where a lot of the excitement was. You'll remember that I had written that I was searching for blockchain's killer distributed applications. You're probably like, okay, Lisa, what's your point? I think realistically, I was probably wrong. I think that really what I mean by searching for the killer application is searching for that next great protocol. And if you look at the distributed application landscape, it's still pretty nascent. There's an amazing website called the State of the dApps, where you can see in real time how many distributed applications are being developed on top of Ethereum. As of the time I put this together, there were 1,500 of them. You can see the categories. Most of them are in games and social. Probably heard of CryptoKitties. It's like one of the best distributed apps out there. But even CryptoKitties, which was invested in by Union Square Ventures and others back in April, is still today maybe a company worth tens of millions of dollars, whereas Bitcoin, Ethereum, et cetera, are worth tens of billions of dollars. And so I think it proves the point that the protocols are where all the action is. The applications might develop in time, but are still pretty early. We at August Capital invested in a really cool company called Spring Labs. And Spring Labs is trying to build a protocol layer for financial institutions. Today, if you walk into a bank and want to apply for a loan, you have to submit pay stubs and a copy of your driver's license and probably a letter from one of the credit bureaus that tries to prove that you are who you say you are. And the credit bureaus represent $40 billion businesses. But as we know from the Equifax hack, they're not particularly secure. You, the consumer, have no access to your own data, no control over your own data. And they don't even really provide all the services that financial institutions need. They don't do anything with anti-money laundering, anything besides just the basic know your customer analysis. And so what Spring Labs is trying to do is take what today is a really centralized process and decentralize it and make it such that Bank of America or Wells Fargo, et cetera, can ping a network to find out, hey, has Lisa been verified before? If so, I'm going to compensate the institution who verified her. And if not, I'll do the work and then be compensated in the future whenever anybody else needs to verify her identity. And so I think it's a really smart use of this protocol layer network effects to create a decentralized way of storing data that today is very centralized. And if anybody is interested in Spring Labs or wants to talk about job opportunities there, shameless plug, happy to chat. As a law school graduate, I would be remiss if I didn't talk about how is all of this being regulated, right? Like as a venture investor, when dealing with something like blockchain, one of the things we think about aside from where is the value accruing, what are interesting applications, is what's the regulatory risk here? And crypto has certainly been full of controversy in the past couple months in regards to will it be regulated as a federal security or not? And if you turn to the federal security laws, all securities have to be registered with the SEC. That's the very basic thing you need to know. And then the question becomes, what's a security? And is a token a security? So a security, one of the things that counts as a security is what's called an investment contract. And that was defined in a really important case called Howey as a contract, transaction, or scheme whereby a person invests his money in a common enterprise and is led to expect profit solely from the efforts of the promoter or third party. It's a lot of legalese, but it's been boiled down to a 4-point test. 1, was there an investment? 2, was there a common enterprise, which just means a whole bunch of people pooling together to work jointly? 3, did the people who invested expect to make money? And 4, did they expect to profit solely from other people's efforts rather than from contributing to the system themselves? And so these security laws are implicated in different ways depending on how the investment in blockchain is structured. You've probably all heard of the ICO, and another phrase for an ICO is the direct token presale. And typically what happens here is the developers of the protocol put together a white paper. That white paper is distributed pretty broadly to both accredited investors and retail investors alike. And the white paper describes the network that will be built, but it's not yet built. And it says, you can buy tokens directly in that future developed network. And then they raise a ton of money. Some of these ICOs have raised tens of millions of dollars. And then all of that money goes towards the development of the network and compensating the developers, et cetera, everything that you need to start a business. Contrast that to the SAFT, which was the brainchild of a law firm called Cooley and modeled after a standard document developed by YC for investments, often in the very first institutional round of a company's creation. That is called the SAFE. This is the SAFT, the Simple Agreement for Future Tokens. And it's very similar to what happens with the ICO, but importantly different in a couple of key ways. Same thing, there's a white paper that's developed usually before the network is existent. But importantly here, accredited investors invest in equity in that company rather than directly in the tokens based on this SAFT. And then money goes to the developers, they develop the network, and it's only once the network is existent and there's actual utility to those tokens. So in the case of Spring Labs, it would be networks created, there's now tokens, banks can transact them. Then me, Lisa, a retail investor, could buy one of those tokens and participate in the token economics that way. So on the left-hand side, the ICO, these tokens are probably regulated as securities. And we've already seen some action on the part of the SEC that suggests that they believe that. On the right-hand side, it's still a little ambiguous. The SEC has not yet ruled, but the SAFT itself that investors invest in is certainly a security. And then there's ambiguity as to whether those tokens, the utility token, is going to be regulated as a security or not, but it certainly seems a lot more likely that because those tokens have a value, people aren't buying them because they expect that they will increase in value. They're buying them because the network exists and each token represents some sliver of utility to participating in that network. So probably more likely to be regulated not as a security. And so our investment in Spring Labs was done via a SAFT. And that's been our view at August. There are certainly tons of investors who are participating directly, not just in cryptocurrencies themselves, but also in ICOs. And that's a super interesting thing to observe as a VC, because it almost poses an existential risk to what venture capital is, because it's decentralizing what we do. So if I were you, and I were thinking about, are there blockchain projects out there that I'm interested in joining? How do I triage this regulatory risk for myself? There's a couple things that I would clearly avoid. No matter what, make sure that the project you're joining is motivated to at least try to comply with regulations, right? So there should at least be a good faith effort to try to be above board. There's a whole host of financial regulations having to do with money transmitter licenses. You have to register with FINRA, all this stuff. And then there's a ton of projects that are trying to register offshore in an attempt to save on taxes. It's probably the case that blockchain tokens are going to be regulated as property rather than as capital gains. But from everything I've read, it doesn't seem like there's actually that much to be gained by registering offshore. So it's probably more of a red flag than anything else. And then look for companies that are raising money off of this SAFT structure. Like I said, proactively trying to comply is always a good thing. If you want to learn more, these are a bunch of the leading lights, both from a technology perspective and also from a regulatory perspective. So Brian Armstrong, founder of Coinbase, Linda Xi, it puts together some really wonderful content on Medium about different cryptocurrencies and also about different events that pull together some of the smartest people in the space. Elizabeth Stark is creating a layer on top of the Ethereum network that increases the transaction time. Catherine Hahn is a fascinating example of someone who's transitioned from the legal world. She was, I think, a federal prosecutor for a while, a Supreme Court clerk, and now is leading Andreessen Horowitz's crypto fund. And so she's a really deep thinker in how all of this will be regulated. And then Matt Huang, along with Fred Ursum, just launched a crypto-focused fund called Paradigm. They're both very smart. And that's it. Please ask questions. Yes?
So that's great. As a VC, you explore lots of different tokens, but I want to know how you get consistent returns from these things, because it's super volatile market.
Yep.
How do you know when to sell out, especially because these products haven't quite come to market yet, or maybe they're not on exchanges? I just want to hear more about that process.
Yeah, we have not yet invested directly in tokens, right? We haven't invested in Bitcoin, Ethereum, or any of the altcoins. I think for precisely that reason, it's way too volatile, and we don't view ourselves as experts. We don't view ourselves as public equity investors in the blockchain equivalent. What we do via this SAFT mechanism is treat it just like we treat equity in any other company. So we're investing now. We know the company's really nascent. It's got maybe 15 employees, and they're going to build over the course of years. And probably our investment in them will last a decade. And at that point in time, we hope that it will be a big business that happens to be built upon blockchain technology, but it's not really exposed to the volatility of cryptocurrencies themselves. Obviously it will have, to be successful, their tokens will need to develop some value and actually be used and things like that, and that's a bet that we're making. We don't know yet how it'll turn out, but if those tokens accrue in value, it's because the business fundamentals of that business are good and strong.
Okay, so within the next year, you guys make any money?
No, probably not. Which is true of any of our investments, right? We invest in, let's say, Warby Parker, or we have a company called GitLab that's growing really fast. You don't really, it accrues in value in that we invest at the Series B, someone else invests at the Series C, and you see an uptick in valuation. You hope it's a really large uptick because the company is growing fast. But we as the investors don't get liquid, so to speak, until it either goes public or gets bought. And here, I guess you could ask the question when investing in blockchain, what's the exit going to be? Is a company built on blockchain going to go public just like any other? Or, will we go public by eventually selling what sliver of the token pool we have to others in more of a secondary transaction? It's possible. But we don't really, our capital doesn't demand that we exit on the order of years, which is the way our fund is structured.
In addition to these questions, so what's the future of the cryptocurrency?
Of what?
Cryptocurrency. What's the future of it?
Of crypto?
Crimes.
Oh, crypto crimes? That's a really interesting question. It turns out if you look at the history of just tech innovation generally, often the boundary of innovation happens at this border between illegal and legal. And some of the earliest adopters of the web were using it for illicit means. some of the earliest adopters of crypto, obviously using it for illicit means. I think, I think that policing of crypto crimes will require some interesting coordination as between public and private sectors. We're increasingly seeing, the folks from Silicon Valley kind of do short stints in DC and then come back. And I think that that's what's going to be required for government to get up the curve quickly to be able to even know what they're looking for in terms of, the forensics of crypto crimes, which are much harder to detect than, Web 2.0 crimes. But I don't know much more than that, unfortunately.
Kind of following up on that in general. So, I mean, obviously, with something like Spring Labs, this is built on blockchain.
Mm-hmm.
Most people here think of blockchain and think of like cryptocurrency or whatever.
Yeah.
And then, is there concern or like any risk analysis that like government would broadly have regulation that would inadvertently affect, technology or companies are trying to build broadly off the blockchain in an attempt to sort of respond to what they feel like are
Yeah, totally, and that's happening.
reacting, do things that come related to other applications off of the blockchain?
Yeah, totally. We've seen many SEC actions brought against companies that decided to do an ICO.
Right.
And why is that dangerous to a startup? Well, it takes a ton of time and resources to defend yourself against an SEC action, not to mention the scrutiny and the negative publicity affects whether a consumer might want to use your product. And so we do think about that. We think a lot about trying to proactively partner with the regulators to make sure that at every step in Spring Labs' development, they know exactly where they stand vis-a-vis the regulators. I think that that's a really important point. Certainly if you're the CEO of one of these companies, you want to make sure that you're thinking strategically about the regulatory angle of it. Yeah.
So I'm curious to know if Spring Labs is the only investment right now in distributed protocols from August. And the reason I ask is because ultimately Spring Labs is a fintech company.
Mm-hmm.
And usually when we think about blockchain, cryptocurrencies is the first thing that comes in our mind, just because I feel like a lot of people are quick to jump to financial applications of technology.
Mm-hmm.
So I guess my broader question is your investment thesis that finance is probably the first viable segment that can be transformed to blockchain, or would you guys be open to investments in other types of distributed protocols that might kind of touch on other verticals?
Yes, definitely open to investing in other verticals. I think that the core of what's interesting in Spring Labs isn't actually the financial services component. It's that they're using blockchain to help solve an identity verification problem. And when you abstract that out of fintech to all sorts of other segments, it applies the exact same way. So our thesis was, hey, we think that blockchain, the technology, is perfectly suited to solving what Web 2.0 has really struggled to solve, which is identity. We expected Facebook to do it. We thought maybe Amazon would do it. No one did it. Maybe Facebook's working on it now, but they have other issues. And so Spring Labs is doing it for, you're right, a very focused vertical. And you can imagine, take supply chain as another great example. There, it's not the identity of an individual human, but it's the identity of an individual pallet, an individual piece of fruit. Like, how do you verify that this is a thing that came from this place? And I think that there are all sorts of other myriad ways that identity is going to be tracked. Like, we were just talking about educational institutions, and like, how does Harvard verify that each of you actually took CS50 and passed it? How does Harvard verify that you in fact graduated? And over the course of your life, like, do you really own that data? Not really. And so each time you apply for a job or apply to grad school, you're going to have to go back to Harvard, pay some money for them to print a form and mail a letter. And wouldn't it be a lot more powerful if that existed in a decentralized network? Yeah.
I've also been a little bit doubtful about the use of blockchain besides cryptocurrency. I think as one of the examples you mentioned, Spring App, it's doing great, the verification of identity. Do you see any other like common areas that can actually use the technology of blockchain?
Great question. One area that I think is really interesting and still incredibly nascent is blockchain for healthcare. There you have the added complexity of, not just regulation of tokens and the financial repercussions of that, but HIPAA and all the regulations that come into play when you have personal healthcare information. But you think about medical records, I think that's a variant of the identity problem we were just talking about. And then like compliance with medical billing is another area that could be really interesting. So I think healthcare is an interesting example. Supply chain, certainly financial identity. What else? The core idea within CryptoKitties of digital assets is also really interesting. There's, I think, there already is within gaming a whole economy of digital assets. And you can imagine in the future that we're all going to own a basket of things, some of which are physical world items and some of which are digital items. And so using blockchain as the record of transaction for those digital items will be another use case. Yeah.
How have you guys thought about the physical, like electrical, like natural resource requirements? Because that's,
Yeah.
I hear about so many great applications, but the biggest limiting factor is like, for the palette example, like how are we going to have that distributed across every single item, and like how much of that of the entire ledger needs to be stored in each individual unit?
Totally. Question was, how do we think about the energy implications of building upon blockchain? I think that it's a great point. We definitely think about it. We think about it from the lens of, okay, you look at blockchain as the technology. As a technology, what is it good at and what is it bad at? Well, what is it good at? It's a fancier database. It's a distributed database. What is it bad at? It's actually kind of slow, and it's very energy intensive. And so it's good for applications that can't be solved by a centralized database like identity. And it's bad for things where you have to ping the database really quickly, really frequently. So that's why like a Spring Labs, where maybe you ping the database once on the order of a year per customer. And it's probably bad for a marketplace or a financial exchange and things like that. And that's why you're seeing folks like Elizabeth Starkness try to develop the Lightning layer on top of Ethereum to help accelerate development of applications on top of it. Yeah, so we definitely think about it as part of the why now. Like, is this actually the right time to be investing, or is this still maybe a year or two too early in the development of the technology before things really start to take off? It's a tough thing as an investor because you don't want to wait until it's too late, but we've invested in tons of companies that were a year or two ahead of their time and just didn't work out because adoption wasn't ready to take off.
How do the underlying protocol, the cryptocurrency value, and the application on top of the technology affect each other? So earlier this year, the cryptocurrency values were just like off the roof, and then now it's really low. How does that affect the application that's built on top of it? And also, when a business becomes successful, how does that impact the value of the cryptocurrencies and underlying protocol?
Yeah. The question was, how does the value of the protocol tokens affect the applications being built on top of the protocol? CryptoKitties, a great example there. Back at its peak, I believe that there were 120,000 daily active users of CryptoKitties. This was like November 2017. And then they got $12 million invested from Union Square Ventures and another really top-tier firm. Now, if you look at the daily active users, it's down in the 1,200s or so. Really has taken a dip, in large part because the value of the Ethereum token underneath is a lot lower than it was back in the peak of November 2017. So I do think that there is a strong correlation as between the protocol value and the application value. Probably part of the reason why the app layer is still as nascent as it is. And an interesting question to ponder of like, how do you, as the application, try to mitigate yourself from that volatility? I don't know the answer to that, but it's interesting.
Then why don't you invest in cryptocurrency themselves?
Well, we've seen a lot of VCs choose to do that. And I think, so, our investment in Spring Labs, because it's an agreement for future tokens, eventually we will get Spring Lab coin. There are plenty of VCs that are directly invested in Bitcoin, Ethereum, Ripple, et cetera. And, most have done exceedingly well because they have accrued in value so dramatically. And I think if you really believe that the protocol layer is where the value is, that actually might be the right answer.
With the Spring Labs application to the better customer process,
Yeah.
I imagine there's banks, verifiers, and users who need to all get on board to make this work. How do you think about these more complex marketplaces, and what do you see among the three parties the biggest initial adoption?
Yeah, it's a great question. And an important point to remember that when investing in blockchain, there's kind of a two-level analysis. First, it's ignoring the blockchain part of the business. Is it a good business? Does it have good fundamentals? If it's a marketplace, does it function as a marketplace? And then looking at the tech stack and making sure that that's all solid and makes sense. So if you take Spring Labs as a marketplace, you're right, it requires, importantly, the financial institutions to want to use it. Because unless Bank of America is willing to ping Wells Fargo and get compensated in Spring Labs token, it's never going to take off. And there, I think that certainly our diligence was in large part talking to financial institutions with whom Spring Labs had already partnered to better understand why they were excited about using it. And it was, they view this KYC process as a cost center. And so being able to partner with an entity that wants to help reduce that cost, they view it as a win-win. But still, you're right, that the earliest adopters are going to have to believe in the value of that token because they're going to accrue a higher amount of token before its value is really demonstrated.
A question that kind of leads off of what you just said. There are just so many protocols in the market right now.
Yeah.
And you can't envision just one succeeding. There'll probably be multiple blockchain technologies, and there's going to be need to be some technology to talk chain to chain and all that. And kind of wondering how much research have you guys done into that to figure out, if he's going to be Spring Labs won't be the only people doing this kind of stuff. And secondly, just to comment on something else that was said was as it relates to energy consumption. In addition to power, proof of work, there's proof of stake, there's other consensus algorithms, and I'm wondering if you guys, looking at any of that and how, and that technology side of things.
Yeah, the mining side of things, it has also been an area ripe for VC investment. Analogy much more to the server infrastructure layer of the web. We have not played there. I don't know if I have a really satisfying answer for you as to why we haven't played there, aside from no particular domain expertise on our end. But I think it's fascinating because some of the biggest companies existent within the space writ large are actually huge mining operations. And so just intellectually, it's interesting.
Yeah, I think even Ethereum, it's just proof of work now, is moving to some sort of proof of stake, hybrid system. So I don't think the energy consumption will continue to be the problem that it is now, unless they can find that it's just not as secure or trustworthy of a validation scheme, to make sure that everything, that all the chains sync up and the data is accurate.
Yeah, your point about in the future there's going to be a whole slew of protocols is absolutely true. Unrealistic to believe that because Spring Labs has taken financial institutions as its vertical, that they're going to somehow have a monopoly over all transactions there. I think it's going to be just like what we see for the web. There's going to be healthy competition by vertical, and then someone's going to build a really interesting business trying to be the interoperability layer as between all of these different tokens. That might be Coinbase. I don't know.
How do you think that the regulations and taxes and user responsibility affect the development of this technology?
Kind of to the point earlier about crypto crimes, I think that entrepreneurs are incredible humans and are always pushing the boundary, kind of regulation be damned. And so I haven't seen so much reticence to develop for fear of regulation. I think what we're seeing is now a little bit more enthusiasm for proactively partnering with regulators. Like the legal standards are kind of becoming well known enough, and there's also lawyers who are now decently expert in the law as it pertains to crypto, that even a really fledgling startup can get pretty high quality advice about how to navigate the regulatory landscape. And I think that investors are kind of voting with their dollars as to investing in those companies rather than companies that are being a little shadier. And so I think all of those things are forces for good in the development of the technology, because the more examples we have of amazing companies, amazing investments that are built upon blockchain, the better will be for folks like you to be in this room thinking like, oh, okay, I want to start a company in this space. That's what I see. Yeah.
I'd love to hear more about your experience with the SAFT with Spring Labs.
Yeah.
Normally I'm more familiar with ICO. So do you have like equity in Spring
Yep.
Labs that provides you with equity?
Correct.
And so you also are going to be entitled to future Spring Lab tokens when they produce them, and you have probably an agreement about some amount.
Correct. So the question was about the SAFT and how it works technically. So set aside the SAFT for a second. Let's think about the SAFE. When YC invests in a company via a SAFE, what they're investing in is in a sliver of the company that will convert upon the first priced round. So it's basically saying, like, we don't really know yet how much you company is worth. We're willing to wait until, say, an August Capital steps in and says at Series A, okay, you're worth $24 million. And then that note converts in at the $24 million valuation. Here, with the SAFT, we're saying, we're going to invest now. We don't yet know what the tokens are going to be worth. But we're going to give you, some money up front that's going to be worth a certain percent of your company. And at some future date, when we know what the tokens are worth via the pricing of the token economics, our sliver will convert into whatever number of tokens it's worth. Right? So you're right that from an investment now perspective, it's just like buying equity in a company, nothing to do with the tokens. And that's why it's very clearly, it's a nice legal form, because it's so clearly a security as governed by the SEC, and you don't really have to worry about the ambiguity of what a token is.
So what happens to your equity upon this conversion? So like, is each token now representative of equity in Spring Labs as a whole? Or is it just the financial vehicle for the banks to do identity verification and pay for each other? Because now it's kind of blending these two things.
You're right, it's blending utility and security. Upon that conversion, it's a good question. I don't know exactly whether there is still any equity remaining outside of the tokens, but certainly some sliver of our equity converts into token. And I think at that point, you can wonder, okay, are we, as August Capital, really holding those tokens for their utility, or are we expecting that they will accrue in value? If so, that's an investment, not a utility, right? And maybe there's a provision in there about cashing out at some set date. I don't know. I'll look into that.
Can you imagine a post-cryptocurrency world where folks are less concerned about the asset value of the tokens from a speculatory perspective, where blockchain becomes more of a utility? It's like a fixed fee or commodity, kind of model, where you're solving kind of real problems that exert cost or friction on the economy, and the speculation part kind of fades into the background.
I would love to live in that world. The question was, can you imagine a post-speculative blockchain world? Yeah, I think we think often about trying to look at the companies we invest in as companies, not necessarily as blockchain companies, kind of pre-imagining that commoditization in a way. because if you're there's certainly a lot of utility to investing solely for speculation, and a lot of people have made a lot of money in that way. And in fact, speculation is how a lot of this technology is going to get adopted, because there's just economic motive there. But yes, I think 10 years from now, 20 years from now, blockchain will be a layer in a host of applications with which we interface daily, and isn't necessarily the driver of value in those applications, just enabling. Yeah.
You kind of talked about ICOs as democratizing venture capital,
Mm-hmm.
and I'm curious what kind of your thoughts and other VCs for value kind of are doing to adapt to this kind of new world.
Yeah. The question was about ICOs as the existential threat to VC. It's a great question. I think that from the perspective of an entrepreneur, if you had a choice of, hey, I can broadcast to the entire market what I want to build and just sit back and wait, and people can kind of come to me and decide to write checks or not, I would take that all day, every day, rather than having to drive up and down Sand Hill, pitching people like me, trying to get them to be like, yes, I will give you $10 million, right? So I totally get it from the entrepreneur's perspective. What I think it does from an incentive to build perspective is a little perverse. Like if you raise $80 million before you have a business model and product market fit, I worry about whether the company that will be born of that initial upfront investment will be as healthy as what the traditional venture capital model allows. But of course, I'm biased by the position I have within a VC firm to think that my model is the better model. I think that firms have taken all sorts of different positions on this. August probably being among the more conservative. You see Andreessen Horowitz dedicating a separate crypto fund. There are tons of emerging crypto funds like Paradigm. Yale University just announced that it's investing some of its endowment dollars in Paradigm, which probably means it's now directly invested in some cryptocurrency assets. So, yeah, I mean, I think if you're an investor who wants to hedge your bets, should probably be treating ICOs seriously, accounting for that regulatory risk. Yep.
How do you diversify your blockchain portfolio? So you have an identity project.
Mm-hmm.
You're trying to get multiple identity projects. So you think, okay, maybe I'm going to get the one big one, or you go, okay, now let's focus on gaming, let's focus on gambling. Trying to diversify across that space. What's the obvious capital?
Yeah. The question was, how do we diversify our blockchain portfolio? We think about diversifying our portfolio across a whole host of dimensions. Certainly one is by sector. So if you look at our portfolio, it's about half consumer-facing, half enterprise-facing, and within those, probably the bulk of our investments fall in one of four pillars. One's enterprise infrastructure, one's application layer, one's financial technology, and one's like consumer e-commerce and marketplaces. And so I think we would expect our blockchain investments to be spread across those four pillars, just as any other investment that we make that's incremental. We don't tend to invest in two companies that are going after the exact same space, just because we're fiduciaries on the board and can't invest in two companies that are directly competitive. That said, financial services obviously a massive market. Could I quite easily imagine two companies, both based on blockchain, going after different parts of the financial services infrastructure that we would both invest in? Totally. So I think it's very much an ad hoc, opportunistic thing based on the quality of the team that's pitching, the quality of the business model that they're pitching, and the size of the idea behind it. I'm guessing that this marks the end of lunch hour and the return of class. Any final questions? Thank you guys. This is fun.